Hello, everyone. We're just going to wait a couple of minutes for people to arrive. And I've got Tim Morgan with me, who is luckily without kids this morning, spending a night in a hotel, and still decided to spend his morning with us rather than having a lie-in. Thank you, Tim.
Yeah, you're very welcome, Nick. As I said, this might be the one morning of the year, but here I am.
The one chance. Just as a reminder for all the attendees, do move, like, either use your the Q&A during the chat, use the Q&A function from Zoom, or move your chat to participant and attendees so we can all see your questions. In Q&A, I think your questions are going to be a bit more anonymous because they're going to stay just between us. And Emily and I will manage the questions. This is a slightly, oh yes, one thing that I've learned, one thing that I've taken from Joe in the past few events, is I quite like to ask everybody to say hello in the chat and tell me where they are, basically, so we can have a quick view of where people are. But basically, this is a slightly different format than what we normally do. So normally, Smart Cookies is a half an hour with 20 minutes talks, and then the rest being QA. This one is slightly different, where it's just going to be a nice chat between Tim and I, and trying to learn basically about what VCs are looking for and what's the landscape today in the Southwest, primarily, I would say. So welcome, everyone. Thank you very much. What we're going to do is we're going to kickstart with a quick presentation from Tim about him and Southern VC. If you need to dash at any point, or I know quite a few people are looking for recordings of those sessions after the event, Emily's going to drop in the chat a link to subscribe to the newsletter, and then she will send basically a link to the YouTube recording after the session. So without further ado, Tim, thank you so much for being here. Do you want to go for a quick presentation about yourself?
Yes. So I mean, just the sort of salient parts of those are that originally I worked in financial services. I then founded a software and design company called Mint, and then out of Mint we span out multiple kind of startups, some of which I led and then when we spun them out, we would raise venture capital into them. So my first experience with venture capital was probably about sort of 12 years ago, when I was on the other side of the table as a founder, and then subsequent to that, so for the last sort of 3 years, I've been running Southwestern, but just for kind of clarity, Southwestern is not a venture capital fund. So a venture capital fund is really a bunch of people who are called LPs contribute money into a fund, and then a manager, who's called a GP, in return for a fee, deploys that capital. At Southwestern, I don't do that. So at Southwestern, I deploy my own money. So I invest I don't have a fund, fundamentally. I only have my own money. I generally write the first check in the first round, so I'm a very early stage investor. And then what I do is try and help those early stage companies as much as I can, and that generally at some point is a road to further rounds of fundraising, which is where the kind of main flow, I guess, of work with real venture capitalists who have funds of different sizes kind of comes in. So that's just kind of like a point of clarification, really. But yeah, so that's basically me. I guess I've been an investor, I've been an operator, both as a founder and as a sort of senior manager on startup teams of different flavors over the years.
Well, I guess that's kind of like a very nice segue to my first question, which is there fundamentally a big difference with let's say a small VC firm like you, like an independent VC, and what typically is referred as a business angel? Like, is there fundamentally a difference in the role that they take when they invest money? or is it more just potato, it's the same name, but like they still give money and they try to help?
Yeah. I mean, again, this is where the misnomer is. So theoretically, there is no difference between me and a business angel, I guess. You could say that. Whereas there is a difference between business angels and venture capitalists. The big difference is that a venture capital fund has a 10 or 12-year lifespan normally. So they've raised money with a promise to deploy an amount of capital over a fixed time frame with various terms attached. So they might say, okay, we've raised £100 million fund, and we're going to write 10 million pound checks into health tech startups at the Series B level, and we're going to do 1 year for 10 years. The cadence of them is a lot more frequent than that, but that will give you an idea of the kind of rules of a venture capital fund. And in return, the partners will take, or the managers, I guess, will take a fee of say 2% of 100 million. So they might take £2 million a year to manage that fund. The reason I say it's professional is that once the money's raised, I mean, theoretically, if everyone just decided they didn't want to do it anymore, they could. There probably is a mechanism to give the money back. But ultimately, that is the purpose of that fund. It doesn't have any other things going on. Whereas a business angel or somebody like me, there is no requirement to deploy capital. So basically, imagine if I didn't see a good investment for 20 years, then I don't invest any money for 20 years. So angel investors generally hop in and out of it. It's an interesting point though, because you do get more, like business angels, as you can imagine, they're almost, you have the complete range of people in there, in so much as some of them are making their first investment, some of them only invest in people that they already know. Some of them are much closer to a venture capitalist, i.e., even if it's not a legal requirement to deploy capital, there is some mindset where they're thinking, right, I'm going to be really a professional investor, and I'm going to invest money every 3 months into tech startups. So there is a difference between angels and venture capital funds. I guess the angels themselves can be a lot more kind of like erratic. So even though venture capital funds themselves can be very different, angels can be really, really different, right? So sometimes you meet someone who says, oh, my friend Sally is a business angel, and in and of itself, that could mean she's invested in one company. It could be that she does one company a month. It could be that she invests £10,000 a go. It could be she invests £1 million a go. So you get a real kind of mix on the business angel side. It's almost too broad of a term actually, because theoretically anybody could be a business angel. It's just what
as long as you can invest money and you have enough money to invest to attract someone. But I think the pattern I've seen in the people that have been much more successful than me, that they can now actually invest, but they are coming from the grunt of having funded those tech companies, most likely, or at least the ones that I follow. They have already funded tech companies in the past, and now they have the capital to make it back and then invest, basically. One of the and play that role as an angel. One of the pattern that I see is they seem to be, even if they're not investing in a lot of different companies, they don't have the spray and pray kind of approach. They seem to be extremely invested in the companies that they invest on. And I think for you, it's the same. Like when I look at your socials, when you're not talking about politic runs and Bitcoins, you actually talking about the startups you invest in, and you're helping them to recruit, you're helping them to find the right talent, you help them solve problems. And like, what is the life of an investor effectively for the startups you invest in? Like how invested are you, and how do you measure your level of investment, your personal investment, not your money investment, but your personal investment, mental investment, I would say, in the startups that you work with?
I mean, for me personally, you're right, actually. I would say that I don't make many investments, but when I do, I try and sort of go hard to help them as much as I can. The first 2 years of a startup's journey are very difficult and lonely, and present a bunch of challenges that certainly for most first-time founders, they're unfamiliar with. So they're presented with things where they have to act quickly, make good decisions that are somewhat unfamiliar to them. So really, by the way, I don't sort of force this on them, but if I can help, if I can see an opportunity to help them. So for example, hire in, you know, sometimes it's product development, go to market. Sometimes it might be an introduction to someone that I think might be a customer or something like that. Then I, you know, I'll try and do that. I guess the question, so my mentality actually is that I do think about them sort of all the time. And the other thing is I try and make myself available to them. So it often involves, you know, a phone call late at night, for example, or, you know, on the weekends, which is that I think if something has come up and is a challenge, it's often something that actually can't wait. It's something that's sort of causing disruption to an entity that has a fairly short time frame to achieve something. So as much as possible, I try and, you know, just move problems out of the way so that the founders that I work with can concentrate on what I perceive to be the sort of the real challenges, which are really around product and market. So yeah, if I can sort of grease the wheels so that they get more time on those fronts, then I feel like I'll be succeeding. And yeah, you know, I do that because I think, you know, I want to be helpful. But there are many investors who, it's not that they don't want to be helpful, it's just like an hours in the day problem. So you know, if I invested in 10 times more startups than I do, then there wouldn't be enough time. You know, yeah. There are other things that I need to take care of as well. So really that is the kind of the currency, I think, of that type of help, which is, you know, how much time is this person, you know, do they have? The other thing is often skill set. Like the type of person you just described as an angel does exist for sure, but there haven't actually been that many large tech exits in the UK, full stop. I mean, it's a growing number. I'm very sort of bullish about the direction of it, but it's not like Silicon Valley where there is a rich ecosystem of exited founders or early employees who had options. Like that is still somewhat unusual. So a lot of business angels in the UK have made their money in a different industry. So they might have exited a company that was, you know, a manufacturing company or a distribution company, but they realized that technology is a sort of new frontier or where the growth might be, and they're interested in it. But in those cases, you know, if you ask them, can you if a founder asks one of those people, can you help me hire a machine learning engineer? Well, presumably they wouldn't know any more about that than the founder. In fact, they probably know less. So ultimately, it kind of depends. What's good, I suppose, is that most founders know what they're getting into at the start. You know which type of investor you've got, because they'll normally tell you. Some of them will say, you know, I'll provide you with capital and then that's it. Just keep me updated. That's all. You know, I just want to know what's going on. Or others will say, I'll provide you with capital, but also I can help you with X, Y, and Z. You know, I'm always at the other end of the phone. Please let me know if I can be helpful. So, yeah, going back to your first question, you just get this kind of like range, really.
But I think what that leads me is we talk a lot about like a lot of the startup founders are always, how can I make myself attractive to investors, and like how can an investor invest in me? And I think they forget that it's a two-way equation, and you have to find the right investor for you at your stage. And sometimes having somebody that can be a little bit more involved is extremely valuable, and like you need to recognize that. And I know Dave, tomorrow I need to raise some money. Having somebody like you that actually invests mentally in my journey is something ultimately I would like to find. But maybe that's a personality trait as well. And some people just like, do you know what, give me the money, I give you some return, hopefully in 5 years, but for the moment let me concentrate on what I have to do. Now I guess that's the segue to the next question, which is what are the top qualities an investor is looking for in business owners? So if you're looking to invest, what are the top 2-3 qualities that you're looking for that would be a big no if they were not there?
The first one is it's quite kind of like nebulous, I suppose, but it's the ability to get stuff done. The number one trait for founders inside and outside of technology. So if there is like a kind of secret sauce to to people who I think are well suited to it. It's that they are a combination of impatient and action oriented. If you put those two things together, then stuff happens, right? So like, so a good example would be, you meet somebody in May and they're a startup founder, you ask them what they're working on and they tell you, and then you meet them again in June and the problems or challenges that they face has changed. It's not exactly the same as it was in May. There are some things I realize, because bear in mind I work at the earlier stage, there's some things that people can't do without capital. So if I see them in May, I don't expect them to have hired 10 engineers by June, because I know they haven't got the money to do that, say. But there's always something you can do to move the needle, because startups involve an awful lot of uncertainty. So the first characteristic is like, are they consistently and persistently moving forward? And it doesn't mean that they're succeeding, it means that they're finding out. It means that they are, because they're reducing the uncertainty and the risk in what they're doing, because they have more information, or they've made some form of progress in some meaningful way. So that's the sort of like the first thing. And then, I mean, by the way, these are just me, right? Like if you ask 10 versions of me, you'd get different answers. I think I like people who are somewhat like a kind of underdog, I suppose. I don't know whether, I've never really kind of formulated that, but like, I think one characteristic that I see that sort of works quite well is if somebody really feels like they have something to prove. I think if you're somewhat kind of like indifferent to the outcome, then you're likely to have a sort of lukewarm outcome. So there's, I don't know if you call that passion, or like some sort of form of kind of, I really want to achieve this, and not just because I woke up one morning and thought of it, but because there's something more about realizing my full self, in fact, and because that's the stuff that doesn't go away when it gets hard, right? Like, so that's something that I look for. And then another big part of it is like, if you're going to be a successful founder, you're going to have to attract capital, you're going to have to attract talent, i.e. hire people, and you're going to have to attract customers. So you have to be somewhat compelling. Like, and I realize again, like I'm not the sole arbiter of what's compelling, but I will make my mind up in terms of, do I think this person could persuade people to invest? Do I think this person could persuade talented people with other options to join their company? And do I think this person could persuade a customer to choose them over a competitor? The hard thing about all of that, and it's a really interesting area you got to, Nick, because I think investing is part art and part science, and you've kind of gone to the art, which I think is the most interesting thing. Because at the earliest stage, there's no real due diligence. It's really about a person, or maybe a market as well. So to be fair, there's another side of it, but mostly say about a person, and you have to make your mind up very quickly. So oftentimes, when people say no, when angels say no, or when venture capitalists say no, it isn't because they don't like the person, or they don't like what they're doing, or that they're certain it's a no, in the same way as if I said to you, Nick, do you want to drive to Newcastle tonight and watch basketball with me, right? You probably certainly don't want to do that. In most cases, these no's at the early stage are, I don't know enough about this, and I haven't got enough time to invest in finding out. Because if I spent 30 hours with every single opportunity or founder that came across my desk, which I think is a reasonable amount of time to really get to know them, to really understand, then there wouldn't be enough time in the week. So that time frame is kind of compressed. And yeah, I mean, the lesson of it is actually, which I'm trying to get across, is if someone says to you no, and they give you a pretty lame reason, it might just be that what they're really saying is, I don't know enough about it, and I don't have enough time to find out enough about it or about you to make a good decision. Which again is why often some of the best sources of early stage capital are people that you know, or people who are known to people that you know. And I realize that's dissatisfying from a kind of nepotism perspective. I completely understand that. But the reason for it is the familiarity and trust, basically. So the first person who ever invested in a venture of mine was my boss. I'd worked with him for 4 years. I'd resigned from the company, and I told him what I was doing, and he said, why is he saying yes? He didn't, at that point, he doesn't really know what the company's doing. He doesn't ask many questions about that. It's because he's worked with me for long enough to know that I'm sincere, I'll try hard. I haven't just woken up one day and thought about it. It's something that's been kind of brewing. And that really is like a big part of the kind of challenge, is how quickly can I get to know this person so that I can make that judgment. It's hard.
Cool. I think one of the reminder when you were talking about the the trait of the founders, and to have these, to be likable, to be like investable, to be good employers, like to be attractable for employees and all that. That kind of like always reminds me these entrepreneurs that say, oh, I created my company because I'm unemployable, and they like to put that as a badge of honor. And I've always been disliking of that. It's like, look, if you're starting a business, it's not because you're unemployable, because you're going to have to be employed by a lot of people, whether they're VCs, whether they're your own employees. You're going to be likable to a lot of people. So actually, that's not the real badge of honor here, to be unemployable, I don't think. But
yeah, I know what you mean, actually. And the sort of entrepreneurial journey is sort of quite rich with slogans, and everyone's trying to find a formula. And I find life is very nuanced, and you can tell, by the way, because if you just concentrated on social media, then what you'll notice is that thought leadership and the formula changes every 3 months anyway, which means that obviously it's a journey, it's not a destination. People are just trying to figure this stuff out. But it's deeply personal. There is no one size fits all. Everybody is different. And really what has to happen is people need to find ways, I think, of kind of playing to their strengths. But to do that, you have to know what your strengths are, and you have to know who you are, and that in and of itself is quite difficult. With the I was unemployable type of mantra, I think one thing it does speak to, which is worth noting, is the how much you have to lose, because risk isn't just a function of the opportunity and your mindset, or your appetite for risk. It's also a function of how much you have to lose. And often entrepreneurial journeys start with people who don't have much to lose because they are unemployable. If I said to you, Nick, okay, you can either start a startup or you can get a job at Morgan Stanley, and I guarantee you a salary of £500,000 a year, and you can work from home 2 days a week, and whatever, right? Like suddenly your appetite to start that startup is kind of different, because you've got this compelling, lucrative proposition on the other hand. Often those people who say I'm unemployable, they don't have any employment. That's what they're trying to say, right? Like I've made myself, so I'm never going to get that offer. And so often what appears to be a risky endeavor isn't that risky, because there's no opportunity cost. There's nothing valuable that they're giving up to start the journey. It's the only journey that they could take, given what they kind of know about themselves. And I think that's probably what they're saying.
Yeah, we should. Yeah. in terms of when an investor, so let's talk about the early stage now. The early stage investor comes in and invests, and I know, again, it's one of those questions that will have a myriad of answers, so let's narrow down to you. Basically, how much influence do you think you have on the startup direction and growth, basically? So we talked a bit how you helped, but how much do you think you influence where the startup is going?
I mean, I'd like to say as little as possible. Like I don't, there's absolutely no kind of like master plan where, like, I meet a founder and I think, right, I'm going to spend the next 6 months steering you in this direction. Like that just doesn't happen. It's more like I assess them and think, yeah, I think this one is a good one, like for me. By the way, the for me part is interesting as well. Sometimes it's a good match, right? Like there's nothing more to it than that. No, I try not to do that, Nick. If I think they are going off course, in certain ways, I think it is incumbent on me to mention it to them, but not in front of other people, not to give them a hard time about it. The reason it's incumbent on me is like anything. If you noticed a friend who you thought was, yeah, there was just like, it's the right thing to do if you've noticed something, to say like, actually, I think this would be better positioned in this way, or we've obviously thought about this in a certain way, but I think maybe the strategy should change, or even some new information has come to light. I found this out, like I've done some research. I think maybe you should kind of consider that, but never to sort of try and grab a hold of the steering wheel and cut, like never, not like that. Like so to the extent
Let
that
me do
it
it.
happens, yeah.
Let me do it.
Exactly. Mostly because in every single case, I believe them to be better drivers than me. So yeah, it would create a worse outcome if I was holding the wheel, for sure.
Fair enough. Right, I think we got quite a few questions that have been asked. So I'm going to go through them, and we're going to try to answer them in a maybe in a shortish manner. But so Sunday's asking, so they're helping build a 5-year financial model for startups that's going for investment. So the headlines are like KPI, cash flow, P&L, and their question is, how much details do an investor wants to see below those headlines? So how much do you want to see for these 5 years plan? Which is it possible to do a 5 years plan? I don't know. I've struggled enough to do a 12-month plan personally for my company that's been 10 years old. So, but yeah, how much details do you want to see personally below these headlines?
So actually the detail is valuable for one reason only, which is it forces you to have thought about it. I don't really care too much what the plan says, as long as you have thought about it. I don't expect the plan to be correct. 5 years is far too long, by the way. Like, so if you were to accurately predict what would happen for the next 2 years, you will be a genius if this is early stage stuff. So 5 years is, it's well into it's so far in the future that it sort of almost doesn't, but I think it's a great exercise for any founders to think like that. So it's weird, and I don't look at the 5-year plan and think, wow, this is what's going to happen to this company. But I do look at something like that and think, wow, these people have really thought about it. They understand fundamental principles like gross margin versus net profit. They understand the amount of capital intensity required in this business. And it's like writing something down. All I care is that they've thought about it properly and that they've bashed it around a little bit. And because by doing that, you will uncover challenges yourself. And that's really the exercise I want to do. That's the value of a plan, rather than, someone who's actually able to accurately predict exactly what's going to happen. It's much more a demonstration that you care and that you understand.
The next question is for Molly. So basically, they are becoming a B Corp. They've changed the article of associations, and they are on the fulfill on the purpose basically. Now, because they're B Corp, they seem to mix it that they're not going to be, that the aim is not going to be profit basically as a primary objective. How can you still make yourself investable effectively when you are at such an early stage, when you are moving towards that direction?
I think you need like-minded investors. So there's actually quite a lot of people these days who are sort of B Corp evangelists and cheerleaders who have who are high net worth. So ultimately, for some people it's a tick in the box, and for others it's off-putting. I don't think it. Yeah, obviously they're still the minority, but it's almost like picking a sector in a way. It's like saying like, I'm going to do something in health tech. Well, that automatically removes a big majority of investors because they don't know enough about, say, biotech. And in this case, you are removing the total pool of investors. You're reducing it, but hopefully it's offset by the fact is you're increasing the passion or the likelihood of someone who does care about that stuff from investing. It's becoming increasingly common as well, so they shouldn't feel like it's that they're the first person to suggest something like this. So yeah, they certainly shouldn't be feel awkward about it.
Phil is asking, like, in a tech-enabled startup product, what key element are you looking for? Is it scalability, tech choices, North Star, strategic levers? What, like, if you're going to invest in a tech startup, what are you looking for from the tech perspective or from the company's perspective?
There's something related, like we've spoken about people and now we're talking about tech. There's something sort of in between those two things, which is the market. The market is as or more important than, especially in the early stage, than the tech, I guess. So the market is really like, how big is the market opportunity? The one exception is like deep tech. Some of the things I've been involved with require a degree of technical understanding that very few people in the world have, right? So there are some areas of, certainly of biotech, some areas of machine learning, some areas of actually sort of regular software engineering where there is a skill set that is hard to find. So it's not that, so, and the test would be, if I put a job ad for this tomorrow, how many people would be able to build it? In those cases, the tech is very important, right? And really, but it's less about how much do I know about this stack, and it's more about, again, how much do I know about this person? Is this person a sort of elite level within their field? So really, I would assess the tech via the people building the tech, if that makes sense. Very, very few startups don't make mistakes. So normally, there's a bunch of cycles where something that's been built is torn down again, or, you know, it's very rare that, you know, every single technical decision is the right one. So yeah, I mean, I'm not quite sure that answers the question. Like, obviously, if it exists, the proof of any tech is the use of it, right? So, but here's an example that, which I hope will be helpful. If you're going into a tech-enabled market, right? So like, you don't necessarily need deep technical skills to succeed. So if you take say like a Deliveroo type of a product, right? Then the question, as well as like kind of who's building it, is like, what other competitive advantages does this company have other than the tech? So if the tech itself isn't like a deep moat, i.e. a bunch of teams could replicate it with enough time and capital, there has to be something else about the business that is defensible. Otherwise, if they're right, if the founders are right about the business, i.e. there is a good opportunity there, then immediately any engineering team within a company or new engineering teams will replicate and try and compete. Like that is absolutely guaranteed to happen. So you need some form of long-term defensible advantage. And if it's not the technology, it has to be something else. It really does. It can't just be that you're the first person to have had the idea. Because if you're proved right, someone will replicate it if the technology is trivial.
Well, that kind of leads me to the question that I was alluding to in the practice section that sometimes I'm too afraid to ask, I would say. So as you know, we build product for startup founders, but most likely those startup founders are really good in their market, they're really good at what they're doing, but they're not tech people. And we build crazy solutions for them, like typically high level, very, very tech enabled startups. And now let's put the basis straight, which is they have full IP, they have full ownership on the code, like everything is, all the tick box, the normal tick box, I would say, are crossed. Are they viewed differently when their original MVP is built by an external company? Are they viewed differently from an investment perspective compared to a tech founder that is building his own product, basically?
Yeah, the answer is yes, but with like a big asterisk or sort of caveat attached to it. So any tech startup founder who is coming to raise some money, who has persuaded, so imagine you've got a non-technical CEO and they found a technical CTO who is very competent and credible and has built V1 of the product in their spare time or without raising any money, and has taken that to market and has had some modicum of traction, right? Like, by the way, this is rare, but imagine if that
has a lot of steps, yeah.
And it was profitable and they didn't need to raise any money.
And yeah.
Imagine if that happened, then, you know, that in and of itself, we're laughing about it, but it's sufficiently there's a lot of hurdles there, like that non-technical CEO will have had to have overcome. Whereas if they use a third party, the main one they need to have overcome is access to capital. So if they happen to be rich, or they happen to be able to find money to build, then they can do all those steps. So it's kind of like, it's a different journey, I suppose, yeah. is the way I would see it. The truth is, the big risk, if you are that solo non-technical CEO, you might understand the market perfectly. You know everything there is to know about the insurance market, but you don't know a software engineer, or you don't know one well enough to, like, I don't think you can kind of force that, because putting together a founding team, like, one of the biggest risks in any startup is that they fall out. So the more familiar the founding team is, the better. Or just have one founder. Like, some people don't like that. I think that's absolutely fine. In fact, I think outcomes can be better. So this sort of false kind of marriage of two people, I think, is worst of all. And that's why I think there is, and there will always be, a market for third parties to build this stuff, because ultimately what the founder needs is proof. They can't have proof without product. They can't even, otherwise they're just using words. It's much easier to use pixels to show someone how it's going to work, right? Get people excited about it, get customers using it, maybe, like, all those things de-risk a proposition and make people more likely to invest. So I see it more like, it is just a case of horses for courses. Like, if you're at home today and you used to work at a tech startup and you know lots of engineers and you've known one for 6 years and you start a company together, then obviously there's no need for a company like yours. But if you're not, like, I don't think it's the case that, therefore you can't enter the tech entrepreneurship ring, because you evidently can. And I think what you do is a sort of valuable part of that. I've also seen it work. Like, I know that it can work. It creates questions later on down the line, and I hope you don't mind me saying this, Nick, because ultimately, if you raise some capital, normally the idea is that you build your team in-house, or there's some transition arrangement. But very frequently, there have been successes where V1 of the product has been built by a third party to get up and running, to prove something, to validate it, to get more money, to eventually bring it in-house and kind of go from there.
That's always been our aim. Our aim has never, like, we don't want to stay, like, we don't want to milk the company ad vitam aeternam. It's more like, look, we're going to help you to get somewhere. We know that at some point we're not going to be the next part of the journey, but we help them recruit their team, basically. And we've done that like a couple of times now in the past 10 years, where it's like, look, now you're in Series A, your investors will want to see a team. Like, we can't be the bearers of your technology, your tech business, even if you're delivering food or delivering things or doing this thing, like your tech business, you need to hire your team now to be prepared for your investment. And we start to help them recruiting these 1 or 2 key people that will be on their side. We help them to still, like, we still have the knowledge of the platform, so we help them to go fast when needs be, so we can still act as developers on the platform. But now the ownership of the product is on them. Like, I think it's I've always seen that as a healthy transition. Like, these companies that try to cling on for too long, is always like, look, it's fine, let it go. I mean, it's probably because also I like the early stage part of a product, and the later stage part of a product requires a lot more, a bit like you, that requires a lot of time, a lot of deep thinking, that it's not really profitable for the startup to continue hiring us at that stage. It's like, look, let us help you for the first 1, 2, 3 years. And then we put the team in place, we help you hiring, and then you move on, basically. And for the moment, we found that quite healthy. So
I mean, I hope you don't mind me saying this, but like, you also find yourself a little bit in the shoes of a venture capitalist, because one of the hard things about investing in tech startups is the amount of time it takes to get a result. So, if you invest in the stock market or cryptocurrency, you might get a result in 3 months, right? You might get 10 times your money back in 3 months. And it's a liquid market, so you can get out easily. These days, you're probably looking at 5 to 10 years in tech startups, maybe longer, before you really get a kind of definitive result. And so, you're working on things today, Nick, that you won't know whether they have resulted in the long run, right, in a resounding success until the year, say, 2031. and that kind of slow cycle, it is hard, because in the meantime you have to continue to self reinforce, right? And it's a very immature market as well as the other thing. So like technology generally, it feels like it's, it's a mature market, but I honestly think this is still like the Wild West. This is really, really early. And you, Nick, are a pioneer in it, right? And but unfortunately, like versus your life, the amount, like the results actually take quite a long time to kind of percolate through. But I'm absolutely convinced, and there are examples of sort of very big companies that started in the way that you described, but there are more examples of them on the West Coast of America, because they have just a more mature ecosystem, more people trying stuff, later stage companies, bigger outcomes. And I think we'll get there, but like, when I say we, I mean like the UK and ultimately the southwest of England. But we are behind them in terms of that cycle. We have a less mature ecosystem.
Yeah. Well, that you mentioned the Southwest, and I think we promised in the intro that we're going to talk about the Southwest. So let's make it the last question before we break. Thank you for everybody who's hanging on there. What is the state of the Southwest basically around investment? I mean, we know I've been long enough in that Bristol to London train to see all the investors, or all the startups, basically everybody that gravitates around the engine shed or one of those place. You see them in the train quite regularly trying to find capital in London. But has that changed now? Like, what is the state of the Southwest in the investment?
Well, I mean,
map?
a few things to say about that. The first thing is it's generally just a feeling. It's like other things in life, like, I don't know, like a music scene or something, where you sort of see it developing, and then there's a feel like the right question, I think, is it on an upward or downward trajectory, or is it on a flat trajectory? And I think it's definitely on an upward trajectory. Like, there are more, there's later stage companies that have raised a lot of money. There are significant people moving from other parts of the world who have significant growth experience, move into Southwest-based companies as engineers or executives, and they bring talent and skill set that then they impart on the people that they work with, who are more likely to be living in the Southwest. So I think the trajectory of Southwest startups, both financially, headcount-wise, talent-wise, is all in the right direction. It suffers from the results, unfortunately, in our game are generally measured in exits and exit sizes. It'd be great if Bristol had a big IPO or something like that. And I think it will. It's just a question of kind of when. So I think that the kind of like the scene is good. I think lockdown and the end of offices. I don't think offices will end completely, but they're definitely going to be less important than they were. Will be really good for the Southwest. I mean, this might be just, obviously I'm biased, but I think the Southwest of England has somewhat kind of paradise characteristics in that it is accessible. It has decent weather. It has big cities which have culture in them. It's got good academic institutions. Like, if you just run that filter through most parts of the UK, most places fail those tests. So and it's still affordable. Like, that's the one thing that might kind of change. And by that I mean the cost of living. But yeah, if I was sitting, and I've been saying this for years, by the way, since I started Southwestern, overwhelming, setting aside the actual choices I'm making, the people I work with and stuff, if I was sitting at a roulette table and there was a square marked the Southwest, I'd put a big stack of chips on it, because if I could own a piece of the region, right, like, I think you're going to have appreciation in that area. I think it's on a good trajectory. The hard thing about all of that, by the way, is obviously, there will be many failures in there. Like, it doesn't mean that you can't lose if you're in the Southwest. You definitely can, and most people will. But overall, the trajectory is very, very positive, I think.
Cool. Tim, thank you so much for your time today. I think we've answered most of the questions. Yeah, thanks a lot. As I said early on, the session is recorded and it's going to will be available on our YouTube channel. Thanks a lot again for giving your time, and it was like very interesting, at least for me, and I hope for other people. We are going to be back in about 2 weeks' time. This time is going to be actually a cookies developer talking about accessibility. So that's something that's been like in our growth journey to be more mindful about accessibility in all the product that we build, and we've basically entered that realm about 2 years ago, and we've done quite a lot of work around that and a lot of research. And I think Romaric is going to present us how accessibility basically is not just the responsibility of either the developer, the designer, or whatever, is the responsibility of the whole team. But thank you, team. And I think I'm going to close the chat now. And thanks everybody for attending. And Tim, I'll let you go and visit London. Have a nice day in London. It looks like it's sunny as well.
Thanks for having me. And yeah, thanks for everybody who has shown up to watch.
Yeah, thank you very much. Take care. Have a good day. Bye-bye, Tim.
Bye.
Bye, everyone.